Hello friends, I'm Anshama and I'm here to help you understand the concepts of marginal costing and CVP analysis. Before we get into that, we must understand the difference between variable cost and fixed cost. What is variable cost? Variable cost is the cost that is directly attributable to every extra unit of output. It generally constitutes of the direct material, direct labor, and the direct variable overheads. It is the cost that is incurred to produce one extra unit of output. What is fixed cost? Fixed cost is a cost that will remain fixed irrespective of the number of outputs you produce. So whether you produce 1 unit or you produce 1 lakh units, your fixed cost will remain the same. For example, rent. Now what is marginal costing? Marginal costing is the system in which variable costs are charged to cost units and fixed costs are written off in full against the aggregate contribution. It is a technique which is used for marginal decision making. What is CVP analysis? CVP analysis is the analysis of C, V and P. Now what is C, V and P? C is cost, V is volume and P is profit. So by CVP analysis, we analyze how the variations in cost and volume affect my profit. What you see over here is the basic relationship between sale, variable cost, contribution, fixed cost and profit. So sale less variable cost gives you contribution and contribution less fixed cost gives you profit. From this equation, you get two relationships. One is contribution is equal to sales minus variable cost and the other is contribution is equal to fixed cost plus profit. What you see over here, this is the first one and this is the second one, right? PV ratio, again a very important concept for marginal costing. PV ratio stands for profit volume ratio. So a simple percentage formula is contribution by sales. Contribution or profit divided by sales or volume. Contribution can also be written as sales minus variable cost and hence the second equation. Sales minus variable cost divided by sale. Like we read, contribution can also be said fixed cost plus profit and hence fixed cost plus profit by sales. Ratio remains unchanged if you compare two values. Therefore, change in contribution by change in sales also gives me my PV ratio. Contribution and profit, the differential is fixed cost. So contribution minus fixed cost gives me profit. Fixed cost will remain the same. Therefore, change in contribution is equal to my change in profit. And therefore, the last relation, change in profit divided by change in sales is also my PV ratio. The reason why there are so many interpretations of PV ratio is because in the practical examples that you get or the practical questions that you get in your exam, you may have to use any one of these based on the data given in the question. And hence, it's very important for you to understand these relations. Let's come to a concept of break-even point. What do you understand by break-even point? Break-even point is a point where it's breaking even for the company. It's a no profit, no loss situation. So break-even point is a point where profit is equal to 0. So if profit is equal to 0, contribution is equal to fixed cost, right? Because you have just enough contribution to cover your fixed cost so that you are not making profit nor are you making loss. How do you compute this break-even sales? Break-even sales is computed in units by dividing fixed costs by contribution per unit. Let's understand this a little bit more. So, like we said, fixed cost is equal to my contribution. So, I have just enough contribution to cover my fixed cost. I want to find out how many units should I sell to be able to cover my fixed cost. So, I earn say 6 rupees per unit as contribution. So, my contribution per unit is 6 per unit and I have my fixed cost of 60 rupees. So therefore, only when I divide fixed cost of 60 by 6 rupees contribution per unit will I get 10 units as my break-even sales in units, which means that I need to sell 10 units to break even. Another way of looking at it is break-even sales in value. So here we are talking about the amount of sales. So my fixed costs divided by my PV ratio gives me the value of sales that I need to do to break even. What is a cash break-even point? Cash break-even point is a point where my cash expenses are in a no profit, no loss situation. So cash fixed costs divided by the contribution per unit gives me cash break-even point. And one very important thing to note, to keep in mind over here is that we should not consider sunk cost. Why is it so? Sunk costs have already been incurred. It's not a cash fixed cost in future. If there is a question where you have to compute sales at a definite profit level, how will you do it? We compute break-even point by dividing fixed costs. So if I have to find sales at a definite level, the only difference is that a profit is getting added to it. And therefore, I have this fixed cost plus profit divided by contribution per unit. Everything remains the same. Only fixed cost plus profit divided by contribution per unit. In value, it becomes fixed cost plus profit divided by PV ratio. Just turning the wheel a bit, if I have to find profit at a definite sales level. So if you see this formula over here, the one here, one moment. This formula that I'm talking about. So this says sales is equal to fixed cost plus profit divided by PV ratio. If I take PV ratio to the other side, it becomes sales into PV ratio equal to fixed cost plus profit. If I take fixed cost to the other side, it becomes sales into PV ratio minus fixed cost equal to profit, which is what I have over here. Profit is equal to sales into PV ratio minus fixed cost. Another concept that we would like to cover is margin of safety. What is margin of safety? Margin of safety is that extra sales over and above my break-even sales which helps me be safe. It is my margin of safety where I'm covering my costs and then it is my area of safety. So margin of safety is nothing but my total sales or my actual sales minus my break-even sales. So therefore, total sales is equal to break-even sales plus margin of safety. How do we compute margin of safety? Margin of safety is computed by dividing profit by the PV ratio. And again, just turning the equation a little bit, we can say that profit is equal to margin of sales into PV ratio. Also, margin of sale units into contribution per unit gives me profit, because margin of sales is nothing but my component of profit. Also, we have a way by which we can compute PV ratio by using profit and margin of safety. So if I know the profit and I know the margin of safety, but I do not know the PV ratio or the contribution of the sales, I can find out the PV ratio by dividing profit by margin of safety. The percentage of break-even sales plus the percentage of margin of safety will always be equal to 100. So what am I trying to say? That if I have made 100 rupees of sales and at 60 rupees of sales I have broken even, 40 rupees is my margin of safety sales. So my 60 plus 40 will always be equal to 100. Percentage of variable cost to sales plus PV ratio is equal to 100%. What are we trying to say here? What we are trying to say is that a percentage of variable cost as the numerator, variable cost to sales, plus what is the second component? It's actually contribution plus sales is equal to 100%. So sales comprises of contribution and variable cost. So the two have to add up to 100%. And that is what we are doing here. PV ratio is nothing but contribution by sales.